Hello guys, my name is Michael, and in today's video I prepared for you a weekly market forecast based on fundamental and technical analysis, after which you will have a better understanding of the current macro situation and how it can influence the prices of assets like FX, commodities and indices. But first, let me explain what the whole Project Trader channel is. So, me and my friend Peter have decided to create this whole project, which is dedicated to, as the name suggests, traders. So, Peter is an ex-trader at investment bank with around 20 years of experience, and I've been trading since 2014, and since 2017 I am working also as an analyst in a financial institution. So basically, here we are sharing our know-how and experience about trading in the markets. So, if you're into that genre, stick till the end of the video and then decide to maybe subscribe to the channel and follow along if you find this content valuable. So, we kick off with our weekly forecast, as I said in the beginning. And so firstly, we will quickly go through the macro calendar, after which I will summarize the fundamentals, and the last part will be pure technical analysis from Peter. So, let's begin. Okay, looking through the calendar, we must certainly pay attention mainly to the decision on interest rates from a Bank of Japan, which will be published on the night from Tuesday to Wednesday. Although here we should focus not on the decision itself, but on the press conference, because most likely the rates will remain unchanged, and more important, it will be a matter of what the Japanese bank officials will want to do next in terms of bond yield control, as things are starting to get a bit out of hand. But I will talk about it more in a moment. And so, the next publication that we must follow are the CPI inflation and core CPI from the Eurozone, or rather the final reading, because the first figures from January 6th showed that while prices are falling together with fuel and food, the inflation base is slightly but growing. So any reduction to the bottom of the final reading will be a positive signal for the euro. The last key data from the calendar will be PPI data from the US, i.e. inflation on the producer side, which is also in a sense a leading indicator for consumer price inflation. So if we see another decline here as well, it will again be an argument for the euro bulls. Okay, now let's move on to a broader discussion of the fundamentals, starting with yen. Because over the past month, the yen has strengthened by 6.3% against the US dollar and could go even higher. The USD-JPY bulls are discouraged by the Bank of Japan, whose January meeting attracts investors' attention. And therefore, let's talk about it and create a trading plan for the USD-JPY currency pair. So, with its decision in December to extend its bond yield target range, the Bank of Japan has taken steps towards monetary normalization, and there will be no turning back now from that moment. And the losses are huge, but could be even greater if the BOJ waited until Haruhiko Kuroda resigned. But the sooner the better. The yen rose as did Japanese bond yields, but neither caused panic in the financial markets and the global crisis. So this means that further monetary normalization will also not cause such a shock as previously feared. So the market tested the upper limit of the 0.5% yield range for 10-year bonds in the run-up to the Bank of Japan meeting on January 17 to 18. And I think it looks quite logical. While now Bloomberg experts, for example, expects a monetary policy adjustment, the BOJ is open to surprise, let's call it that way, and makes no promises that they won't make another big decision. Meanwhile, the regulator bought 5 trillion yen bonds with maturities from 1 year to 25 years at an auction on January 13th, and after buying 4.6 trillion yen bonds the day before. And so, in the first case, it is the largest bond purchase in history. If UBS and Nomura agree that the Bank of Japan will refrain from further monetary policy adjustments, Morgan Stanley and MUFG, or Mitsubishi Bank, because it is a short from the Mitsubishi Bank name, they disagree. So they believe that the yield range will continue to widen because if the 10-year US Treasury yield is close to 3.5%, the Japanese Treasury yield should be above 0.58%. At the same time, don't expect major sell-offs in response to the BOJ's decision to loosen controls, as hedge funds will start taking profits on previously opened shorts. Next, Citigroup believes that the central bank will completely abandon its yield targeting policy and that Haruhiko Kuroda will thus perform a, we could say, noble act, as they described it, and save his as yet unnamed successor from such a responsible decision. In fact, with Japan's inflation accelerating to 4% in December, the highest level, the leading national CPI in 41 years, it seems a must. So it doesn't matter if monetary policy in Japan is normalized in January or a few months later. With the Fed nearing the end of a monetary tightening cycle and the Bank of Japan just starting it, USD JPY must continue its downward trend. The yen has strengthened against the US dollar by 6.3% over the past month and by 2.3% since the beginning of the year, as I told you a couple minutes ago. And so, in the first case, the yen is the leader among the G10 currencies. In the second, it competes with the Australian dollar. After all, the JPY is the strong favorite in 2023, and the fact that USD JPY's previously established short target of 127.6 was met not in the quarter, as previously expected, but in a month, says traders are willing to buy the yen for dollar. So with that in mind, it's safe to assume that shorts after a correction with the targets of 124.5 and 121.5 are still valid. Okay, with that, let's move on to the common currency, which is euro. And let's start with the observation that from the perspective of the world economy, in early 2023, it doesn't look as bleak as it did at the end of 2022. And the bulls on Euro USD are actively taking advantage of this, and the more so that the rally potential, let's call it in connection with the opening of the Chinese economy, is very large. And as a rule, the dollar falls when the world economy looks better than in the US. So, that time has most likely come. Inflation appears to have passed its peak and the gas prices in Europe has fallen below pre-war levels. Of course, we are talking about Russia-Ukraine war. And according to the latest macroeconomic statistics, global GDP growth will exceed the 1.7% expected by the World Bank in 2023. So China's also rapid recovery after a 3-year lockdown is also a wild card. And so in this context, it is no surprise that US stocks and Euro USD are at their best in 2 months. The German economy managed to avoid a technical recession thanks to government subsidies and a sharp drop in gas prices. In 2022, GDP increased by 1.9%, exceeding the forecast of Bloomberg experts. And so, judging by the dynamics of leading PMI indicators, the recession Eurozone will be mild and short-lived, if it starts at all. At the same time, Wall Street Journal experts predict a 61% chance of recession in the US economy in the next 12 months. That number is down from 63% in October's survey. And so also experts believe that the combination of inflation slowing down faster to 3.1% by the end of the year and the looming recession will force the Fed to lower the federal funds rate. So next we have 51% of respondents that believe this will happen already in 2023, despite statements to the contrary by representatives of the central bank. And so economists are forecasting a peak rate of 5%, which is in line with the FOMC forecast and futures market indicators as well. So according to derivatives, the cost of borrowing in the US in 2023 will increase by 60 basis points, which is basically 0.6%, and in the euro area by 140 points, which is 1.4%. Thus, the Euro-USD rally is based on faster monetary tightening of the ECB compared to the Fed, and optimism about the outlook for the global economy. And so, over a third of the 201 global investors surveyed by the MLIV polls believe the ECB deposit rate will exceed 3.5%, and 15% of respondents expect it to be 4%. So, which will be a new record. And so for Euro-USD, there is no other option than to increase its quote. So, the pair's confidence rests primarily on the fact that the Fed will soon end its monetary tightening cycle. And secondly, there is a lot of uncertainty in the market as to the future of ECB rate cap. So we are talking about the maximum level of the interest rates. So by how much the ECB will increase them? Right now, it is a too broad topic and there is not enough information about that. So with the ECB becoming the main hawk, a level of 1.2 seems within reach. So main obstacle for the bulls is a faster than currently forecast slowdown in inflation in the Eurozone. But it's too early to think about that right now. Therefore, continuation of buying the Euro-USD towards 1.095 and 1.104 should make sense here. Okay, now we will switch to Peter and his technical approach. But remember, those analyses may overlap each other and maybe sometimes show some different perspective, so that in the end you will have to decide by yourself how to plan your trades. So now, on to you, Peter.
Hi guys, how are you doing today? Hopefully everything is alright on your side. Well, we are going to make the Forex analysis, and we are going to go through few FX crosses. Let's start with Euro-Dollar, as we are in a very interesting situation right now. Well, the thing is that whatever you see here, to the left side, this consolidation, we are above right now, all right? So that's very, very interesting thing here. Why? Because as long as we are above 50% of that consolidation, let me place the line, we are in a bullish mode, right? That's the most important thing right now, meaning that the demand, the big demand when it comes to the euro-dollar is around 1.07 mark, right? That's crucial here, in my opinion. That's crucial here when it comes to the euro-dollar pair, right? The thing is that we have quite few another thing here. It's not only 50%, it's also the bullish breakout, right? As well as breakout of this consolidation with this failure over here, okay? So in other words, the demand when it comes to the euro-dollar is around 1.07, number one, okay? Number two, the breakout candle 1.0642, so something between 1.064540, and the last one is the swing low over here, okay? In that case, in that particular case, we are talking about the levels close to 10.520, 10.5. When it comes to supply, this consolidation, which we are testing right now, it's quite important over here, okay? Because here we are around 50% of the consolidation and the swing low. So we have a supply here. If we are going to take out this supply, the next one is going to be above 1.10. So if you are the seller of the euro dollar, you are looking for the possibility right here, right now. If you are a buyer, you are looking for a bigger pullback down towards the breakout candle and 50% of the consolidation. Next one is cable. A very similar situation here with the overall dollar weakness. Now, here we might see strong move to the downside with the huge reversal, right? And the thing is that this consolidation been broken to the upside. We were not able to hold that one, but that's what we are working on currently, okay? So where is the supply? Where is the demand when it comes to the cable? We have to take the weekly open. There you go. And the supply, possible supply, is around this latest consolidation over here. That's the latest supply, okay? 50% on a daily chart. So the supply we are looking for is 23.50. There you go. When it comes to the demand, we are close to 120.60, right? And then again the swing low over here, and we are talking about the 119. Yo, that's the thing we are talking about. If we are going to break the 120, the next one is going to be somewhere here, and we are talking about the levels close to 116.50. That's how I see the things on the cable. In both cases, right now, right here, we are testing very significant supply, and the pullback is very possible. Now, let's have a look what we have when it comes to the dollar yen. With the helping hand from the Bank of Japan, we are right now within the downtrend channel, right? We are testing the lower band of that channel. Now, basically, if we are going to compare euro dollar and the cable testing the supply zone, it's not a surprise that we are trying to bounce here on the dollar yen. With that being said, let's check the levels. In that case, the swing low over here around 130.40, 130.50 is a first supply level. The bulls are going to try to hold the swing low over here, and in that case 127.40. But if we are going to make the zoom, we see where we are. It's another it's another consolidation zone, right? And we are testing the bottom of that zone and the swing low right here, right now. So the bounce from here is not going to be any case of the surprise. The full target, it could be this consolidation ahead of the breakout, okay? So the sellers right here, right now, are sitting around 130.80, 131. The buyers currently around 127.50, and then again within the zone of 123 when it comes to the demand. With that being said, as usual, do your own homework, do your own research before risking real money. It was my pleasure to be with you. See you around, take care and goodbye.